Are we teetering on the brink of a recession?
Exactly. Experts like Joseph Wang, Stephan, and Dowd have analyzed the critical indicators impacting our financial stability.
We've condensed their vital takeaways into concise, actionable insights powered by AI.
Let's dive in. Joseph Wang starts by examining how rising interest rates could shift stock valuations.
And stick around. Stephan, and Dowd will share more insights on mortgages and recession strategies. Today, we're diving into the market outlook presented by Joseph Wang on Markets Weekly.
Wang discusses crucial components like economic indicators and their effects on investor strategy.
Joseph Wang points out that rising interest rates will significantly impact stock valuations.
He also highlights how economic growth projections can lead to shifts in investor sentiment. Joseph Wang emphasizes that higher interest rates usually lead to lower valuations across the stock market.
Does that mean investors should be cautious?
Exactly, as central bank policy changes could signal shifts in market dynamics.
Wang discusses how weekly economic reports can create significant volatility in the market.
What kind of reports should investors watch closely?
He advises to focus on employment and inflation data to gauge market reactions.
What does Joseph Wang predict for the market in the coming months?
According to Wang, there are signs pointing towards a possible market correction as data unfolds.
How can investors adjust their strategies amid uncertainties?
Wang suggests looking towards sectors likely to withstand economic fluctuations.
Joseph Wang concludes that staying informed is vital for making strategic investment choices.
Moreover, diversifying across strong sectors could buffer against potential downturns.
This proactive approach will help navigate the asset volatility expected in the upcoming quarter. Today, we're examining Donald Trump's announcement regarding a 50-year mortgage proposal.
Stephan analyzes its implications for home buyers.
Stephan explores whether a 50-year mortgage can enhance accessibility to home ownership.
He cautions that such extension in debt could lead to financial burdens for buyers.
How does Stephan view affordability concerns with these long-term loans?
He highlights that 50-year mortgages could lower monthly payments, but increase the overall cost of ownership.
Mentions potential pressure relief in the current housing market.
Nevertheless, there are worries that increased borrowing will inflate housing prices, complicating affordability.
What does believe about the future adoption of 50-year mortgages?
He envisions ongoing discussions about the practicality of prolonged mortgage terms.
In conclusion, stresses the importance of understanding the long-term implications of a 50-year mortgage.
He advises prospective homeowners to thoroughly evaluate their financial commitment before proceeding.
Today, we explore insights shared by Doomberg about the ongoing changes in the oil and gas industry.
Doomberg examines how new technologies and shifting political landscapes are reshaping energy markets.
Doomberg stresses that technology is a pivotal factor in enhancing efficiency in oil extraction.
He also mentions that geopolitical tensions are significant in shaping worldwide energy supply chains. Doomberg mentions that advancements in drilling technologies have notably improved extraction processes.
This technological progression allows for tapping into more resources at reduced costs.
Doomberg emphasizes how geopolitical issues often disrupt conventional energy supply lines.
This can lead to changes in global alliances that directly impact oil prices.
What does Doomberg forecast regarding future oil demand?
Doomberg predicts that fluctuations in oil demand will be affected by global economies and growing alternative energy sources.
In closing, Doomberg advises that energy sector stakeholders should be vigilant about technological innovations.
Investors must evaluate how geopolitical issues might influence energy pricing and availability.
Today, we're diving into an analysis by Dr. Emily Brown, featured on Eurodollar University, focusing on the state of our credit system.
Dr. Brown's assessment reveals critical insights into consumer credit health and potential impacts on lending practices.
Dr. Brown notes that the current conditions serve as indicators of risks within consumer lending.
According to her, shifts in consumer behavior reflect larger economic vulnerabilities.
What does Dr. Brown imply the current economic situation means for consumer credit?
Dr. Brown suggests that there could be tightening lending standards, limiting access to necessary credit.
How does Dr. Brown connect current economic conditions to market trends?
She argues that these developments could resonate throughout financial markets, especially in consumer financing.
What predictions does Dr. Brown make for the future of credit?
Dr. Brown forecasts a tightening of credit policies, which could restrict consumer spending if trends continue.
Dr. Brown concludes that consumers and businesses need to prepare for a challenging credit environment.
She advises consumers to review financial strategies in anticipation of shifts in credit availability.
For businesses, adapting to new lending standards will be crucial.
Overall, Dr. Brown emphasizes proactive financial planning during these uncertain economic times.
Today, we're reviewing an important discussion between David Lin and fund manager Lawrence Lepard about the fragility of financial systems and the urgent need for increased monetary supply.
Lepard's insights warn that inadequate expansion of the monetary base could lead to major economic fallout.
Lawrence Lepard suggests that without substantial monetary expansion, we could be heading towards serious financial turmoil.
He links current events to past instances where insufficient monetary action led to economic strife. According to Lepard, previous financial downturns often stemmed from central banks failing to take decisive action in boosting the money supply.
What could be the consequences if they hesitate now?
Lepard warns that ongoing inaction may amplify instability and can lead to considerable societal impacts.
What are Lawrence Lepard's predictions regarding future economic conditions?
He indicates that if there is no monetary policy adjustment, inflation is likely to surge, causing market turmoil. Lepard stresses the immediate need for policymakers to take steps to avert negative economic repercussions.
Does he propose specific measures?
Yes, he underscores the critical need to expand the monetary base to achieve economic stabilization.
What does Lawrence Lepard foresee if current monetary policies stay the same?
He predicts a dire outcome with rampant inflation and economic downturn if immediate monetary expansion isn't enacted.
Lepard concludes by asserting that only timely monetary policies can protect economies from potential collapse.
He advocates for vigilant monitoring of inflation as economic conditions change, urging adjustment in strategic planning.
In today's segment, we dive into Ed Dowd's analysis concerning the current economic challenges.
Ed highlights how positive cash flow is critical in the face of rising asset prices and market fluctuations.
What indicators does Ed Dowd say suggest we might be in a recession?
He cites increasing inflation rates, drop in consumer confidence, and issues in the job market as prominent factors.
These indicators significantly influence consumer spending habits.
Julia LaRoche emphasizes the need for investors to rethink their strategies in this context.
Ed discusses the implications of asset inflation and its potential to cause investor losses.
What strategies does Ed propose for navigating this environment?
He emphasizes the importance of liquidity while advising caution in stock market engagements.
What predictions does Ed Dowd hold for future economic conditions?
He foresees liquidity becoming increasingly important as market fluctuations persist.
To conclude, Ed Dowd highlights that maintaining cash liquidity is crucial for weathering the recession.
He also advises investors to be proactive about potential market turbulence.
Overall, adapting to the economic scenario we face will be key for future financial stability. Wow, what an insightful discussion we had with our experts today.
Absolutely. Each guest brought in unique perspectives that really illuminated the complexities of our current economic landscape.
It's fascinating how they all agree on the critical role central banks have in stabilizing the economy.
Right? But there are some significant differences in how they view the recession. Ed Dowd is quite adamant about its pressing nature.
And then you have Joseph Wang, who offers a long-term view on the financial indicators shaping market sentiments.
Plus, with Lawrence Lepard pushing for aggressive policy actions and Dr. Emily Brown highlighting a more measured approach, it's clear there's some debate.
If you enjoyed exploring these diverse insights, make sure to like and subscribe to our channel.
Your support helps us bring more expert analyses like these directly to you.
And don't forget to click the bell icon so you don't miss our next video, where we'll dive even deeper into the dynamics of the global markets.
Till next time, keep questioning and stay informed.